Now let's move on to this particular question. AG PLC has an administration building which is no longer needs the following a reorganization. Okay, so after the reorganization, the building administration building is no longer need. On 1st July 2019, AGPLC entered into an agreement to let the building out to another company. Okay, so after the reorganization, so they are planning to let out the building. Originally the building cost was 600 million. Date of acquisition 1st January 2010. The depreciation over 50 years. AGPLC applies the fair value model under IAS 40, and the fair value of the building was determined to be 800 million on 1st July 2019. This valuation had not changed on 31st December 2019. Another building has been let out for a number of years. It had a fair value of 550 million on 31st December 2018, let's say 2018, and 740 million on 31st December 2019. So required, demonstrate how these two buildings should be accounted for in the financial statement of AG PLC for the year 31st December 2019 and calculate the amounts involved. Okay, so what is the story here? Now there was an administration building which was converted into a which was rented out from 1st July 2019 onwards. Okay, so which means if it is rented out, the relevant standard which is applicable is IAS 40, so investment property. So this has to be treated as an investment properties from 1st July 2019 onwards. Okay, now till 1st July 2019, so here the applicable standard is IAS 40. So till 1st July 2019, the applicable standard is IAS 16. So you need to apply the fair value method. Okay, so now the cost of the building is 600 million. Okay, and the building was revalued, or the fair value of the building was 800 million as of 1st July 2019. So therefore you need to identify the carrying value. How do you identify the carrying value? Deduct the accumulated depreciation. Okay, from 1st July to January 2010, 1st January 2010 till 1st July 2019. So which means 9.5 years. Okay, so 600 million divided by 50, that is the depreciation method. 50 years, over 50 years it is depreciated, times 9.5. So that will be 114 million. Okay, so therefore the carrying amount of the building is 486 million. So this 486 million, when you take the fair value is 800. So therefore the difference is 314, which is the revaluation amount. So this will be transferred to the revaluation reserve account, 314. Therefore, prior to the transfer to investment property, the property is measured at fair value in accordance with IAS 16. So revaluation reserve of 314 million will be recognized in other comprehensive income. So this will be recognized in other comprehensive income. Okay, and the revaluation reserve amount will be shown in the equity. Okay, so revaluation reserve will be shown in the equity statement. Okay, so then this 800 million will be on 1st July 2019 will be transferred to the this will be transferred to investment property. Investment property 800 million. Okay. So on 31st December 2019, okay, so in the financials 31st December 2019, okay, since the value has not changed, so this valuation had not changed on 31st December 2019. So therefore, since there is no change, this 800 million will be shown as investment property. So had there been any increase in the fair value, instead of 800 on 31st December, let's say 2019, it became 825. This difference of 800 and 825 will be transferred to the profit and loss account in accordance with IAS 40. But in this case, the value is the same, so therefore no adjustment required. Okay. However, the other building has been let out for a number of years. It had a fair value of 550 million on 31st December 2018 and 740 million on 31st December 2019. So therefore, this is an investment property. So therefore, 740 minus 550, how much is that? 190 million will be transferred to the profit and loss account, as in accordance with IAS 40.